This webinar is a continuation and the third part of a series that is specifically designed to get all of you smart on investing in digital assets. So even since the last time we spoke in January, we've seen some very exciting development. And once again, we are seriously excited to keep on sharing these insights with you. So once again, on a high level, at MLG, we fundamentally believe that blockchain is going to have a sizable impact on a variety of industries. While many businesses are in the process of adoption and implementation, one place we keep seeing significant change is in finance, fundraising, and capital markets. So if there are two hot takes that we want you to all take away today, it's that first, while crypto exchanges are integral to the ecosystem for token liquidity and trade, these marketplaces are not wallets, and large funds should not be kept on these platforms. The second is that other than regulation, having high degrees of security is one of the final roadblocks for large institutional capital to move into the asset class. So today, we're going to kick things off with an introduction to some of the features that make Bitcoin so alluring for many and why security is paramount for these assets. We will then take you through the dichotomy that exists between cold storage and digital asset liquidity. And we'll follow that up with an overview of digital assets, institutional money, and custodial options and innovative solutions to crypto's security versus liquidity debate. We'll then cover some new financial products that may actually strengthen hackers' motivations to attack centralized exchanges. And lastly, we'll finish off by going over where we see banking heading in the future, including some exciting new developments that actually just happened yesterday. But once again, a little bit about me. Many of you are probably aware now, but my name's Dave, and I'm the Director of Research and a partner at MLG Blockchain. I've been in this space for a number of years now, having been involved with the FinTech Club and the Scotiabank Digital Banking Lab at the Ivy Business School as president, while also working heavily with the Blockchain Education Network and the Blockchain Research Institute. But enough of that for now. So just before we begin, a reminder that while introductory, some of this content surrounding digital assets does build on our previous webinars. So I highly suggest that if you haven't yet, you go out and you give those ones a listen. So Kyle, our CFO and president, loves this slide. And on a high level, this slide illustrates exactly what was the promise of Bitcoin when Satoshi's white paper was released 10 years ago, initially enamoring so many cyberfunks, hacker hobbyists, computer scientists, and the like. See, Bitcoin guarantees the transfer of value from one person to another without the need for any intermediaries, but even more simply, without the need for any third parties. What's so alluring is that as a Bitcoin owner, I fundamentally own my assets, and I do not need to put my trust in any institution or entity. It's kind of like back in the day when mistrust in banks was at a high level and people would store their money under their mattress. Bitcoin is a digital, safe place to store and transact value. On this next slide, courtesy of Deloitte, we can see just how stark the difference there is between legacy financial systems on the left and our new decentralized model of value transfer on the right. However, as these assets are now fundamentally digital and based on a network technology like blockchain, we now have to ensure that they maintain their security. And despite its importance, security is not really something that comes to the top of our mind when it comes to these assets. The reason is because older forms of digital assets, like music and movie files, were pirated and copied relentlessly, and the internet has emerged out of a culture where this is seen as normal. But Bitcoin and other digital assets are fundamentally different from those assets in the way that they are representative and hold much more value. Even though this makes Bitcoin much more unique as an asset, as a vehicle to move value over networks, it also makes it in a way more fragile. And the reason is because networks fundamentally have value. According to Circle Research, even a year after we experience negative performance from crypto assets as a whole, these networks still possess a staggering amount of value, considering how early many truly are in their development. Other than Bitcoin, which has been around just over 10 years, some of these coins have not even matured past 2 years. Yet, not only do these networks store and hold an incredible amount of value, but this value is traded across the globe every single day. These trading marketplaces have emerged as vital components of the ecosystem, ensuring asset liquidity, and their development is one of the biggest reasons for Bitcoin's impressive price growth over the last 10 years. But despite how important this liquidity is, early developments of the ecosystem have put this important characteristic at odds with another equally important feature, security. In many cases, these features seem to be in direct competition. Liquidity means reduced security, while enhanced security measures open up the possibility of liquidity risk. But liquidity is essential, and the rise of large centralized exchanges like Binance and OKX demonstrate how badly these marketplaces are needed by token issuers. Because of the demand to get listed by projects and ICOs, exchanges have acquired an incredibly powerful position in the market. While I'm not here to take sides on listing practices or the fees charged to get listed, what has become clear is the fact that exchanges are able to charge these fees shows how necessary these stakeholders are to new projects and the ecosystem at large. If reports can be believed, new projects are willing to pay up to $1 million USD to get listed. But storing assets on exchanges also comes with a high degree of risk. And even though it appears as if exchanges have stepped up their efforts to improve security, there are a number of reasons why they're completely vulnerable. One of the most highly touted features of Bitcoin is its decentralized nature. These decentralized networks are hard to hack because they rely on what is known as Byzantine fault tolerance. On a high level, Byzantine fault tolerance guarantees security if one node is attacked, the others recognize the nefarious behavior and that node is shut off. The blockchain can still execute and approve transactions with the will of the majority. Over 51% of the nodes have to be taken control of to hack the Bitcoin network, something that has never occurred. Nevertheless, when funds are held on centralized exchange, this defense model no longer holds up. Suddenly, a great deal of value is being stored in one central location, making it much more vulnerable to attack. This honeypot of value is quite lucrative to potential hackers. In addition, security at centralized exchanges can fail in other ways. Employees can be careless with passwords and security. Users can be subject to phishing attacks where their public and private keys become compromised. And lastly, as a software platform, simple bugs in code or smart contracts can leave these marketplaces vulnerable. On this next slide, we can see empirically that security risks of holding a great deal of value on exchanges. According to our friends at CDX, we can see that 71% of investors hold their crypto on a central exchange. The reasons for this are numerous. As we mentioned earlier, immediate liquidity is very important, but laziness and a lack of education surrounding the risks also play factors here. Due to these proverbial honeypots, we can see 78% of all stolen funds occur on one of these exchanges. And as we can see, as more capital moves into the ecosystem, more value is being stolen. The proliferation in the number of crypto users, as well as the number of exchanges, are the driving force behind this trend. Pascal Gauthier, president of Ledger, says that 2.7 million is lost on exchanges globally every day on average. Meanwhile, our friends at CDX tell us that over 1.8 billion has been lost over the last 7 years, a staggering 25.8 billion when adjusted for inflation. As stated earlier, a lack of investor education is a driving force here. And as we can see on this slide, Coinbase users have grown exponentially, particularly during the crypto boom of 2017. And while Coinbase is perfectly fine as an everyday wallet due to its impressive interface and user experience, very large sums of funds should not be kept on these wallets. While Coinbase has never been hacked, single accounts have been compromised through password mismanagement, among other reasons. Yet, due to its easy user experience, Coinbase is frequently many users' first wallet, with some never upgrading to more secure solutions as their capital within the space grows. As many people listening are likely aware, when one exchange holds too many users' funds or controls too large of a percentage of trade, it becomes a vulnerable honeypot. This is exactly what happened in 2011 with the popular Japanese Bitcoin exchange, Mt. Gox. As we can see, at the time, 80% of all Bitcoin trade occurred on Mt. Gox, a shocking figure. The story goes that due to poor management and weak security measures, Mt. Gox was subject to the greatest security breach in crypto history. 850,000 Bitcoins were taken in the attack, an amount that at the time was valued around 450 million. Today, those Bitcoins are valued at around $4 billion USD. So, what is a more secure way of holding your crypto? Well, many with a significant amount of funds choose to use what is known as cold storage. And cold storage is exactly as the name suggests. It is the process of taking your private keys offline. By not being connected to any network or the internet, you are inherently removing any security risk. While cold storage is sometimes heralded as impressive technology, it is important to note that cold storage is the exact opposite. It is the absence of technology. Private keys, which are essentially the access codes to my digital bank account, can actually be stored in a simple manner, such as written on a piece of paper and placed in a book or in a lockbox, or however one chooses to store it. In fact, some even choose to just simply commit to it in memory, commit it to memory, removing any chance of exterior access. The only problem here is that these keys represent 26-character alphanumeric codes that can easily be forgotten. Simple mistakes in the input of these keys can also compromise it as well. Now, Here is a story that many of you may already be familiar with, but it outlines both the problems associated with long, complicated private key management as well as centralized exchanges. Quadriga Currency Exchange was one of the most popular exchanges within Canada. When you store your crypto on a centralized exchange, you are vulnerable to whatever management decisions and security measures that exchanges may have chosen, as was the case with Mt. Gox. However, what happened here with Quadriga is that the exchange's CEO, paranoid of a possible security breach, chose to commit the private keys to access the whole exchange's funds to memory. Recently, while traveling in India, he died mysteriously, and now customers who left crypto on the exchange are left without recourse. Approximately $200 million is now left trapped on the exchange with no way to access it. What this situation underscores is the importance of key management. Deloitte mentions that users should consider backups of private keys and or multi-signature verification for larger organizations, something that we'll discuss a bit more in a bit. Back to cold storage, however. Cold storage comes with immediate liquidity risk. Because funds are locked away, in the event of an unforeseen event having a major impact on the prices of crypto, it is difficult to move funds. Take exchange hacks, for example. Normally, after a hack occurs on a major exchange, confidence in Bitcoin takes a hit, and we see a corresponding decrease in price. When funds are in cold storage, it may take time to load one's wallet and move into a more stable asset to prevent value loss. Cold storage is also detrimental to the process of staking. Staking is an action undertaken by coin owners under the proof of stake consensus algorithm. Essentially, coin owners are asked to put up a staked amount to verify transactions. If the transaction is legitimate, you receive a piece of the transaction fee. However, if you approved a nefarious transaction and it is revealed that the other nodes, of who there is no possible way to coordinate with, did not approve, then you lose your staked amount. In this way, staking participants are incentivized through monetary reward to always act in the best interests of the economic system. This is a fundamental feature of crypto economics. The drawback with cold storage, however, is that if coins are kept offline, it is impossible to stake them. Therefore, when a staking event occurs, coins must be brought back online, which can definitely be a hassle. And here is just a high-level overview of the dichotomy that exists between liquidity and security. We're now going to switch gears a bit and talk about some effective storage solutions and what it means for the future of the industry. We'll first begin with digital wallets. Simply put, wallets are the name of an application used to help users manage their cryptocurrency. In theory, wallets can encompass simple solutions like we discussed earlier, such as a piece of paper or committing the alphanumeric phrase to memory. They can also be significantly more complex with software wallets, hardware wallets, or combinations of the two. This can also include multi-signature wallets that require more sophisticated governance systems. Most wallets rely on what is known as asymmetric encryption. This relies on both the use of public and private keys. Public keys are the public identity of the wallet. This enables value to be moved and transferred in interactions between different wallet owners, facilitates these interactions. Private keys, on the other hand, should be kept secure and allow for direct access to the contents of the wallet. This is the crux of a wallet's security. A growing trend, however, is also the use of what is called mnemonic phrases. This is a list of randomly generated words that can be used to restore private keys in the event that they are lost. Most wallets now employ the use of these phrases. Hot wallets or software wallets are likely the most widely used. These are wallets that exist on your computer or mobile device. While Coinbase is likely the most popular here, Jaxx and Parity have become quite popular as well. Many of these wallets are integrated with exchanges, allowing for immediate liquidity, but are less secure. Cold wallets, like the popular Ledger Nano S or Trezor, utilize many aspects of cold storage. However, use some combination of a hardware authentication device along with a software operating system. These devices are without a doubt the most secure way for an individual to store and hold crypto. Unfortunately, though, as mentioned, funds must be pulled off the device in order to trade. Multi-signature wallets are often used by large institutional funds. Where in a situation where there may be multiple fund managers or LPs who want some degree of clearance for trades in the movement of funds. For example, if there is a trade below 1 million, perhaps only one manager might sign off. However, if a trade exceeds 10 million, then multiple parties of the fund must sign off. These rules are enforced through hardware and software means and are executed via smart contracts. Nevertheless, wallets still experience some drawbacks. Some are complex and setup is very difficult. With others, key management has not been enforced properly. However, the result, in some cases, has led to millions of dollars in Bitcoin having been lost. However, this is very critical due to the increased attention blockchain and crypto have received from an impressive list of large firms. And currently, other than regulation, security may be one of the issues most keeping capital currently on the sidelines. And as we can see, several high-profile companies are coming into the space for a variety of reasons. The New York Stock Exchange and their parent company, the Intercontinental Exchange, has launched a fully regulated crypto exchange known as Bakkt, which is expected to list Bitcoin futures as well. Fidelity has launched Fidelity Digital Assets, a Bitcoin brokerage and digital asset custodial service. JP Morgan, surprisingly, this week just launched the JPM coin for use in its wholesale payments business. Meanwhile, Morgan Stanley has openly recognized digital assets as an institutional asset class. Furthermore, the CFA has added blockchain topics into its exams, while Yale and other notable schools that we'll look into in a bit have put percentages of their endowment funds into crypto funds. Moving on, prominent investment firms such as Grayscale have estimated that over 70% of its new investors are from financial institutions. But while old institutions are just entering the market, new institutions have emerged as well. On our left, the number of crypto hedge funds has spiked dramatically, in turn causing the number of crypto assets under management on our right to rise in kind. Assets under management for cryptocurrency funds is currently estimated by Morgan Stanley to be about 7.11 billion and growing. Next, we can see due to the relative maturity of the industry, hedge funds and VC firms are dominating the landscape in comparison to private equity. And as we mentioned earlier, Yale is one of just several high-profile university endowment funds that have put their money into crypto. And furthermore, we have seen increased attention coming from several high-profile pension fund managers. So, if a wallet system does not work for these large institutions, how do they secure their funds? Well, many turn to digital asset custodians. Custodians are not new in financial services. They have traditionally been used to empower investors to invest in non-traditional but high value and high potential assets. This includes everything illiquid, everything non-publicly traded, anything hard to value or hard to store assets, such as physical precious metals, private securities, and lending and loan contracts. All good, viable investments. Custodians essentially provide three services. They are in charge of holding the asset, and to do so, they must take over legal title. This point may be a bit contentious, as we discussed, as one of the value propositions of Bitcoin was owning your own assets and not relying on third parties. This service begins to look a lot like a bank for a product that was designed to disintermediate them. However, most of the customers here are large institutions rather than individuals. And so holding their funds, holding their large-scale funds for custody makes sense as a viable solution. Second, custodians safekeep the assets. So this involves whatever security measure, whether it be software or hardware, or multi-signature, designed to ensure protection. And lastly, custodians report the asset. This is done to both the client and to the relevant regulatory authorities to provide full transparency. However, as we discussed in our last webinar, with the coming age of the tokenization of assets, digital representations of these same hard-to-move assets discussed on the last slide can now receive institutional-grade digital asset security. Think commodities, art and fine wine, private securities, and precious metals. Much of the time in crypto, this is done through what is known as a qualified custodian. Qualified custodians are fully regulated financial institutions under the Investment Companies Act and the Investment Advisors Act. Think broker-dealers, banks, and a secure way to store digital assets. One of the immediate benefits to this is that these assets receive insurance under custody. So if anything goes wrong or any kind of theft or hack occurs in an unlikely event, these assets are fully insured. The next point to note is that these assets are subject to federal regulation, reporting and audit. And lastly, similar to banks, many qualified custodians will make loans using clients' assets and make money on the spread. The only drawback of some of these options still exists in the immediate liquidity options. A large new player was announced in the space in October, as Fidelity entered the industry, launching a custodial service for institutions, in addition to a Bitcoin and digital asset brokerage. This is definitely a big move for the ecosystem at large, as many institutions may feel safer storing their money with such a reputable name. Next, we have directed custodians. And while these custodians still take title of your assets, they do not actually place them on their balance sheets. As a result, these custodians don't leverage their clients' assets, but charge a simple fee structure instead for storing these assets securely. They're known as directed custodians because they will not trade or move any client's assets unless directed to do so. In this way, clients still maintain control over their assets, a nod to the ethos of Bitcoin. In this way, digital assets stored by a directed custodian can have more liquidity options than qualified custodians. However, it is important to note that custodians can be both qualified and directed. So in order to simplify this for you guys, we've developed this comparison matrix. Options on the left are inherently more liquid than the options on the right, but are less secure. The options in the top are also generally catered to individuals who own their own assets through self-custody, while the bottom row relies on a third-party custodian and is catered towards large funds and financial institutions. Yet, we have also developed some important case studies on options that seek to provide the best of both worlds in the security and liquidity debate. The first is Ledger. Ledger is a hardware wallet developed out of France. It also provides customizable multi-signature solutions for funds and institutions. They provide an effective combination of hardware and software. The hardware component is designed to stay online while keeping digital assets cold. In this way, crypto owners can still stake their crypto while remaining entirely secure. This solves the inability to stake problems associated with true cold storage, so owners can still participate in the economic system. Kingdom Trust is a highly regarded custodian for all types of digital assets. They have developed an integrated solution known as the Icebox that has developed a unique integration with OTCXN, a trading platform, to allow digital asset trading on closed networks between participants. In this way, owners of large funds can still trade and receive over-the-counter prices for their assets without ever having to leave cold storage. Another solution is to use a decentralized exchange. Decentralized exchanges operate using much different structures than centralized exchanges. In a nod to Bitcoin's true ethos, users can trade between each other completely anonymously. There is also no central point of attack, which means assets are more secure. Users can also avoid the high deposit and withdrawal fees present on centralized exchanges. Lastly, there is no way to manipulate the prices and trading volume because there is no central authority. However, decentralized exchanges are still very much in development. A lack of a central order book and trade repository means trades can occur slower with a higher latency because every transaction is recorded to the blockchain. In addition, interoperability between different blockchains is also fairly limited. As most trade occurs on centralized exchanges, competitive prices and liquidity are often easier to find. And lastly, because users cannot use fiat to purchase tokens, this must be done elsewhere and then transferred to these exchanges to trade. Open finance is an exchange for tokenized securities that operates using this model, but as a hybrid decentralized exchange. While they still incorporate some features of centralized exchanges, such as fiat off-ramps, they also use a non-custodial distributed brokerage wallet that offers a user-friendly interface that is not characteristic of many decentralized exchanges. So one topic I want to cover quickly involves the use of new financial products and how this impacts digital asset security. And one of these new products is insurance. Our friends at CDX have created a smart contract protocol enabling the creation, issuance, and trade of tokenized credit derivatives. By buying these swaps, one can actually keep their assets on an exchange with good conscience because if it is hacked, you are insured for its value against counterparty risk. Simply put, the owner of the swap receives a premium in exchange for the protection against counterparty risk. If the credit event occurs, the buyer is paid out. Think of them as tradable insurance policies against risky events. Over the last 16 months or so, we have also seen the introduction of futures, options, and swaps into the Bitcoin market. This has been conducted by reputable firms like the Chicago Mercantile Exchange. They have also been lauded by many in the industry, including myself, who believe their existence shows signs of market maturation and that these will act as price stabilizers in volatile times. Nevertheless, the existence of these products can actually become quite problematic in the future. We showed this slide earlier, but typically when a large exchange hack occurs, we see a corresponding decrease in the price of Bitcoin. Now, imagine how this fundamentally alters motivations for hackers. In the past, the only reason to hack an exchange would be to steal the crypto present. But now, if I'm a skilled hacker, I can go out to the market and buy a bunch of insurance swaps on the Bitcoin on my exchange. I can then buy a bunch of shorts on the price of Bitcoin. And now I can attack the exchange and steal the crypto present. I am paid out in both financial instruments and in the crypto that I stole. This endeavor is now 3 times as lucrative. While I'm still a fan of these products, these are realizations that we must consider when evaluating the consequences of what these products truly mean. The importance of the security is also becoming paramount as well. Because many traditional financial exchanges have announced they are launching platforms for tokenized securities. And while there are obvious benefits for them to do so, including access to private securities markets and near real-time clearing and settlement, there is a number of security considerations that they must make. The reality is that many of these exchanges are bringing billions of dollars of capital into the space. And while it remains to be seen if public equities will become tokenized in the future, this is an important consideration that these exchanges must make, particularly if this is indeed the future. And this goes for all valued centered on these exchanges within the space. So I think we're going to conclude today with some thoughts on what these digital wallets mean for the future of banking. So when we position our thoughts in the space, I look at three key trends that are occurring. The first is a growing trend towards mobile banking and payments. Whereas back in the day, people used to frequently visit their local bank branch to conduct daily banking, most services can now be accomplished simply from one's smartphone. What this means, however, is that banking has grown to become incredibly impersonal for the average user. I no longer get to go face to face in my interactions with my favorite tellers at my local branch. These people are no longer an integral or daily part of my life. Therefore, for the average user, these personal relationships no longer define a customer's experience with the bank. And in addition, we now have a whole generation of millennials and young adults who feel no loyalty to the institution that they have banked with. Customers must now be won with superior product and service offerings. The third trend here, as we've discussed in our past webinar, is that we are entering a paradigm for the tokenization of assets, particularly financial products. What this can enable is for digital wallets to become a one-stop shop for everything of value. Think my Bitcoin, my top 50 currencies, commodities, stocks, futures, mutual funds, and the list goes on and on. Now, there's some out there that believe that now that these assets are tokenized, we will now have the ability to fundamentally spend the value we have, for example, with a true asset-backed token, a token that is representative of the value of our wallets and can be spent on everyday purchases and goods. Now, if you think that these wallets might never make their way into the hands of everyday consumers, guess again. Take yesterday's news, for example. Yesterday, Samsung came out and announced that the Galaxy S10 will feature built-in crypto support. And if you really think about it, it makes a lot of sense. One of the last avenues large tech mobile giants have stayed around the fringes in is in personal banking. However, this actually represents an opportunity for these providers to become the everyday storage solution of the future. And while many of us may no longer be loyal to our banks, we are certainly loyal to our phones. This is a leaked shot released on Twitter that I hope everyone is able to see, but is the interface of Samsung's crypto wallet. Now, if anyone has any questions, please don't hesitate to reach out to myself or the team at MLG Blockchain. MLG Blockchain is a global venture creation and advisory firm with blockchain technology development and broker-dealer capabilities. At MLG, we are completely immersed in this stuff every day. We constantly have our ears to the ground, listening for emerging trends. We have global reach and work with some of the best in the business. We have a team that has vast experience in both the blockchain and crypto and financial markets. And we are a completely compliant firm that ensures investors and issuing companies are always protected. MLG Capital has a variety of core competencies and offerings to best serve our clients. And we ensure that we only offer up high quality projects with high quality products, management teams that represent strong investment potential. And finally, we are looking to provide you, the investors, with the tools to successfully navigate this space and the key considerations that we are on the lookout for daily. Our aim at MLG is to significantly speed up your understanding of digital assets and their markets and put you in a position to succeed. And this concludes our presentation. I want to thank you all once again for taking the time out of your day to come and learn about this fascinating and rapidly growing industry. We're here to take all of your questions, comments, and concerns and look forward to learning and growing with all of you